This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, August 7, 2026, and this is the New York session. Now, let's get into it. The market is trapped in a paradox. Bitcoin is climbing above $65,000, while the fear gauge plunges to 14 out of 100. We are witnessing a structural fracture between retail psychology and institutional reality, where the collapse of leverage meets the quiet arrival of traditional finance. Good morning. This is ShadowQuant Crypto Edition. Today, Friday, August 7th, 2026, we are looking at a market defined by extreme dichotomy. The Fear and Greed Index is locked at 14, signaling absolute panic, yet the total market capitalization has expanded nearly 1% to $2,303 million. Volume is sustaining at $53 billion, but Bitcoin futures demand has cratered to levels not seen since early 2024. Let's get straight into the data. Looking at the macro landscape, the SIBO Volatility Index, the VIX, is sitting at 15.81, down 6 cents. That is low. It suggests traditional equity markets are complacent, but inside crypto, the equivalent measure is screaming. The disconnect between a VIX of 15.81 and a fear index of 14 is the defining feature of this session. We also have a regulatory backdrop shifting. A U.S. Senate housing bill now includes a ban on central bank digital currency issuance, effectively removing a major structural threat to decentralized assets. And geographically, we see massive capital flight. Iranian crypto outflows have spiked 700% following recent military strikes, forcing capital into borderless rails regardless of the broader fear narrative. Let's look at the headlines moving the needle right now. First, Cointelegraph reports that TD Securities identifies NYSE tokenization as an institutional turning point. Second, CoinDesk notes that PayPay, which owns 40% of Binance Japan, is seeking up to $1.1 billion in a Nasdaq IPO. Third, Cointelegraph details that Bitcoin futures demand has fallen to 2024 lows, raising questions about institutional exit. And fourth, CoinDesk confirms that Core Scientific turned lower after disappointing Q4 results, adding minor side pressure. The headline that matters most for sentiment is the TD Securities report, calling tokenization an institutional turning point. That phrase alone is trying to anchor the 12% of traders who think the worst is happening. Because when you pair that narrative with the fact that Bitcoin is up 1.1% to $65,182, despite the 14-point fear score, you aren't seeing capitulation anymore. You're seeing absorption. The retail crowd is scared because they see the red in the fear index, but the price action is quietly ignoring it. The divergence is the signal.
I'm looking at the tape and I'm not seeing a turning point narrative yet, I'm seeing a support test. Bitcoin at $65,182 is hugging a hard horizontal block. The key isn't the headline, it's the absence of selling pressure. With futures demand at 2024 lows, there is no leveraged baggage dragging this price down. The chart is clean, it's a consolidation base. The fact that Cardano is up 4.6% to $0.20 shows that capital is rotating into these consolidation zones before the wider market catches up. The structure is holding.
Grid is missing the velocity. Yes, the chart is clean, but look at where the flows are going. Cardano and Chainlink are up, plus 4.6% and plus 1.6% respectively. That isn't random rotation. That is money moving into infrastructure. The PayPay IPO filing for $1.1 billion is the catalyst connecting traditional equity markets to the Binance ecosystem. We are seeing smart money front run the institutional gateway. They aren't buying Bitcoin because they are afraid. They're buying Cardano and Chainlink because they know where the institutional liquidity is heading next. The flow is distinct, away from speculation towards settlement layers.
So we have a battle of narratives. Pulse sees absorption of fear, Grid sees a clean technical base, and CIPHER sees a rotation into infrastructure. Let's drill down into Bitcoin first. It is at $65,182, up 1.1%. How do we interpret this level?
At $65,182, Bitcoin is demonstrating that the $70 psychological barrier is softening, but the 65,000 mark is rigid. This is a classic accumulation footprint. Look at the 24-hour range. High of $65,312, low of $64,124. The price has rejected the lower bound twice, with futures demand at those 2024 lows. We don't have the washout volatility usually associated with this kind of tight range. It's a slow grind, not a bounce. The lack of derivative interest means the price is being set by spot buyers who aren't leveraging. It's a low-energy, high-integrity hold.
Low energy doesn't mean safe energy grid. You're describing a liquidity vacuum. Bitcoin futures demand collapsing to 2024 lows sounds like relief, but it's actually dangerous. It means there are no hedgers left to buffer a move. If a single large entity decides to offload spot Bitcoin now, there is no derivative cushion to absorb it. We saw earlier that Iranian outflows spiked 700%. That's distressed, non-recurring capital moving fast. If that capital starts rotting, or if regulators crack down on those borders, we could see a flash crash with zero liquidity to stop it. You call it a clean order book. I call it a thin ice sheet.
That's a fair risk assessment, SPECTER, but it ignores the counterflow. You're worried about the Iranians selling, but you're ignoring the pay IPO. $1.1 billion coming into the Nasdaq, where a company with deep ties to Binance Japan creates a massive inbound wall. That is recurring, structured institutional capital. It offsets the distressed flow. The VIX is at 15.81. It's stable. The risk you're pointing out assumes the traditional markets stay flat while crypto wobbles. But if equities remain calm, that $1.1 billion IPO filing acts as an anchor. The spot market isn't empty. It's waiting for that equity capital to convert.
And let's not forget the psychological component. The fear index is at 14. When sentiment is that deep in the red, the average participant stops watching the charts entirely. They log off. That gives the smart money, the people CIPHER is tracking, complete control over price discovery. There is no noisy retail trader selling at 65,000 now. They're gone. So yes, grid, it's a clean board, but it's also a lonely one. The danger is that when the pay news fully hits, the lack of existing participants means the move could be vertical simply because nobody is there to sell into it. Moving from Bitcoin's consolidation, let's look at the leaders. Cardano is the top performer, up 4.6% to $0.20. Chainlink is up 1.6% to $8.25. Why these two?
Technically, Cardano's move to $0.20 is a breakout from a multi-week symmetrical triangle. It's breaking the upper boundary. Compare that to NEAR, which is down 2.8% to $1.64. The chart is telling us that the market is punishing high beta speculation and rewarding established utility protocols. Cardano has broken its local downtrend. The volume accompanying that move is healthy, not spiky. It's a steady climb. Meanwhile, Chainlink at $8.25 is testing its previous resistance, now flipped support. The relative strength between Cardano and NEAR is the clearest technical signal on the board today. Old guard utility is winning over new narrative speculation.
It's not just technicals, it's legal clarity. The TD Securities report linking NYSE tokenization to Cardano and Chainlink is the driver. These assets are the plumbing for that future. When you look at the on-chain data for Cardano, you see staking participation remaining stable despite the price drop earlier in the week. People aren't unstaking, they are holding. That supply shock, combined with the influx of capital anticipating tokenized assets, pushes the price up. It's a fundamental repricing, not a chart pattern. The market is pricing in the probability that these networks become the settlement layer for traditional finance. That's why they are up, while the rest of the market shrugs.
I'll challenge the idea that this is a fundamental repricing. Cardano's 4.6% jump feels like a reaction to a single headline, not a sustained trend. Look at the laggards. XRP is down 1.1% to $1.04, and Polkadot is down 0.8% to $0.8165. If the tokenization thesis were true, Shouldn't the entire sector lift? The fact that only two assets are surging, while the majority bleed, suggests this is a narrative pump, not broad-based adoption. And remember, Core Scientific just reported disappointing Q4 results. Miners are under pressure. If the big players like Cardano start correcting after this initial rush, the volume drying up in the secondary coins will leave them exposed. Don't mistake a headline-driven pop for a structural shift.
SPECTER is focusing on the laggards, which is valid, but he's missing the sentiment shift. The fear index is at 14. In a true crash, everything goes down together. Here, we have a mass exodus from speculative assets like NEAR and XRP into perceived safe utility tokens. That is a defensive rotation. Retail isn't buying the moonshots. They're hiding in Cardano and Chainlink. It's a flight to quality within the crypto asset class itself. The fact that XRP is bleeding confirms that the speculative water is receding. The money hasn't left crypto, it's just moved to the lifeboats. Let's pivot to Ethereum. It is at $1,928.04, up 1.5%. It is lagging behind Cardano's percentage move, but showing solid strength compared to the broader market. What does the data show for Ethereum?
Ethereum at $1,928 is respecting the 1,900 level as dynamic support. It's a slower mover than Cardano, but the structure is tighter. The 24-hour range is $1,893 to $1,934. It's grinding higher with lower volatility than Bitcoin. This suggests patience. Where Bitcoin is making a statement at 65,000, Ethereum is whispering. The ratio between Ethereum and Bitcoin is stabilizing. Usually when Bitcoin leads with gains while alt-season narratives heat up, Ethereum gets left behind. But here, Ethereum is gaining ground relative to alts. It's becoming the anchor. Technically, this is a coiling spring. The volatility compression on Ethereum is greater than on Cardano. Expect a sharper move once it breaks the upper bound of its current range.
The flow data backs that anchor theory. Ethereum is the primary collateral in decentralized finance. As institutional players look at tokenization, they need a liquid, secure layer to hold the value. Ethereum is that layer. The TVL total value locked in Ethereum-based protocols isn't spiking wildly, but it's sticky. Unlike Cardano, where we see rapid accumulation, Ethereum holders are distributing slightly, but only to swap into staking contracts. It's a consolidation of power. The 1.5% gain is modest because the big players are accumulating slowly over weeks, not days. They are using Ethereum to park capital while they wait for the regulatory clarity promised by the CBDC ban in the Senate bill. It's a waiting game, but the position sizes are increasing.
Sticky TVL is good until it isn't. My concern with Ethereum at $1,928 is the correlation with the VIX. The VIX is at 15.81, which is low, but if that ticks up, Ethereum often takes the hit faster than Bitcoin because it has more residual leverage in the derivatives market. You mentioned the coiling spring, grid, but coils explode both ways. If the pay IPO doesn't generate the expected excitement, or if the Iranian outflow data triggers a regulatory scare, Ethereum has less downside protection than Bitcoin did when it held 65,000. The whispering can quickly turn into a shout if sentiment snaps back from 14 to 20.
But SPECTER, you're assuming the snapback happens. We are at 14. To move from extreme fear to caution requires a massive shift in human behavior. It's harder to get excited than it is to stay terrified. The 1.5% gain in Ethereum while the fear index is frozen at 14 is proof that the sellers are exhausted. There is no one left to sell. The sticky holder behavior CIPHER mentions means that even if the price dips, it won't find the same volume of sellers. The emotional exhaustion is the strongest support level we have right now. We've covered Bitcoin, the leaders in Cardano and Chainlink, and the anchor in Ethereum. Let's look at the laggards to see where the risk is concentrating. Solana is up only 0.7% to $73.85. Ripple is down 1.1% to $1.04, and NEAR is down 2.8% to $1.64. What is happening in these names?
Solana at $73.85 is struggling to hold the 73 level. It's forming a descending wedge, but the volume is drying up. It's not breaking down aggressively, but it's not breaking out either. It's stuck in the middle. Contrast that with near at $1.64, which is clearly in a correction mode. The minus 2.8% move is a response to the capital rotation we discussed. Money is leaving near for Cardano, technically. Near needs to find support near the 1.60 level. If it breaks that, we could see a deeper retracement. The chart for Solana is neutral to weak. It's lacking a catalyst to join the rally.
The issue for Solana is purely competitive. The tokenization narrative favors networks with stronger governance and established legal wrappers, which currently lean toward the Ethereum ecosystem and Polygon-like architectures. Solana's strength is speed and consumer apps, but right now, institutional capital is prioritizing compliance and structure. The 1.7% gain in Chainlink versus the sub-1% movement in Solana tells me that oracles and infrastructure are preferred over raw execution layers right now. The flow is shifting away from speed narratives toward trust narratives. Until a new catalyst emerges for Solana, it will continue to underperform the tokenization plays.
And that underperformance is the risk. When Solana stalls and near bleeds, it drags the overall market sentiment down. Even though Bitcoin is up, the weakness in the mid-cap alts creates a drag on the fear index. If Solana fails to reclaim $75, which was the high earlier today, it confirms that the bullish momentum is strictly limited to the top three assets: Bitcoin, Ethereum, Cardano. Everything else is secondary. That narrow leadership is risky. If Bitcoin sneezes, the alts like Solana and Near will catch pneumonia. The lack of breadth is the biggest technical flaw in this rally.
I agree with the breadth concern, but look at the magnitude. Cardano is up 4.6%. That's a huge move for a large cap. It's carrying the weight. The fact that Near and Solana are down doesn't negate Cardano's strength. It just means the alt season isn't broad-based yet. It's selective. Retail is picking winners, not throwing darts. The fear index is low because people are scared of losing money on bad picks, not because they're selling everything. They're consolidating their bets on Cardano and Chainlink. That's a sophisticated form of fear, not a blind panic. Let's bring in Apex for the final synthesis. We have Grid identifying a clean technical base at Bitcoin's 65,000 level. CIPHER highlighting the flow into tokenization assets like Cardano and Chainlink due to institutional gateways. Pulse noting the exhaustion of sellers at a 14-point fear index, and SPECTER warning of the liquidity vacuum and narrow breadth. How do we navigate this?
This is a classic divergence setup, but with a twist. Usually extreme fear, 14 out of 100, coincides with a breakdown in price. Here, price is holding or rising, Bitcoin up 1.1%, Ethereum up 1.5%, while fear remains extreme. That is a bullish divergence. Grid's observation that Bitcoin's 65,000 support is holding due to low futures demand is correct. The lack of leveraged longs means there is less fuel for a violent reversal. However, SPECTER's warning about liquidity is crucial. This rally is narrow. It is driven almost exclusively by the tokenization narrative affecting Cardano and Chainlink. The rest of the market, including Solana and Near, is still suffering from the broader fear. The synthesis here is that the smart money is not betting on a general crypto boom. They are betting on a specific sector shift toward institutional infrastructure. The risk, as CIPHER noted, is that if the pay IPO fails to deliver expected volume, that specific narrative could cool rapidly, dragging Cardano and Chainlink down with it. But for now, the data supports a long-on-dip strategy for infrastructure assets, while avoiding the high beta speculation that is getting flushed out.
To summarize the ShadowQuant Crypto Edition for Friday, August 7th. First, the market is exhibiting a strong bullish divergence, with Bitcoin holding above $65,000 despite a fear and greed index of 14. Second, capital is rotating aggressively from speculative layer ones like Near and XRP into infrastructure and tokenization plays, led by Cardano's 4.6% gain and Chainlink's 1.6% rise. Third, the collapse of Bitcoin futures demand to 2024 lows suggests the market is deleveraged and ready for a smoother ascent, provided liquidity conditions hold. Finally, while the VIX is low and equities are calm, the narrow breadth of this rally poses a risk. If the tokenization narrative falters, the lack of broad participation could lead to a quick cooldown. Tomorrow, we will watch how Bitcoin responds to the closing of the Asian session and whether the PayPay IPO filing generates additional institutional chatter. This is ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.